Here.
Division 4, Justin Lane. Division 5, Robert Harris.
Here.
Division 6, Marlon Barnes.
Here.
Division 7, Gary Van Dam.
Here.
Dwayne Chisholm.
Here.
Lee McElhaney.
Here.
And Holly Hughes, present.
Thank you very much. Item number 4, public comments. If there's anybody in the audience that wishes to address the board on any item that's not on the agenda, please feel free to do so now. Okay. Item number 5, new business. I don't see any there, so we'll skip on to item 6. Items for consideration and possible action. Item 6A1 and 6A2.
I also move on this.
Second.
Can we approve them with one vote since they're there? Okay. All in favor?
Aye.
Aye.
Opposed? Thank you. So moved. Item 6B, Finance Committee, Director Donato.
Yes, thank you. The Finance Committee met yesterday, went through several items that are here on the agenda. The first one, we're going to have our presentation by PFM Consultants during our second quarter, fiscal year 2018-19. I'm going to have, so just come on up and give your name and.
Hi, I'm Richard Backey. I'm with PFM Asset Management. As you indicated, we're the consultants to the agency. You go ahead and begin.
Yeah, go ahead.
It sounds good. So on my presentation, which you should also have a copy of it, looking back in 2019, because the report really covers the quarter ending December 31st of 2018. You look at basic economic conditions. Upper left-hand corner, GDP trended up for the year on an average basis. The upper right-hand corner is inflation, and the beige line is the core PCE, which is the Fed's preferred measure of inflation, hanging out right around the 2% level, which is the Fed's preferred level for inflation. Unemployment rate down on the bottom left, 3.9%, even though it went up slightly in the last report, it's still very low. Consumer confidence, consumers driving most of the economy, remains very high. So overall conditions in 2018 were favorable, but what we saw at the end of 2018 was really a significant shift in sentiment. So what this is the VIX index, a measure of stock market volatility. The blue area is what it was in 2017. So we had a stock market that went up over 20%, but volatility on a day-to-day basis was very low. And the stock market in 2018 actually went down, but there was a lot of volatility on a day-to-day basis, especially at the end of the year, because what the market became concerned about was they do expect the economy to slow. They were worried about peak corporate profits, which means stock prices wouldn't be going up as much. They were worried about a global economy that was slowing. They were worried about the Fed that at that time was continuing to say it was going to raise interest rates, making stocks less competitive. And it was worried about a political situation that continues in Washington that creates additional uncertainty. So what we saw is a sharp correction in the stock market, part of it's been recovered since then, and a sharp drop in interest rates. So what this is, the table on the left is just the actual interest rates in numeric. The chart on the right is the same information. And for the first time in 10 quarters, we saw the 2-year Treasury in the quarter lower than it began. And what we've seen is since the end of the quarter, as interest rates have gone up and down a little bit, but traded in a very narrow range. The market's trying to figure out what could happen. The current expectations are that we're not going to see interest rates trend up significantly or at all during 2019, absent some developments that would be favorable. Meaning we could get a trade deal with China, the political situation resolves itself, China doesn't slow down as much as expected. Those things could contribute to positive growth. Absent that, people are looking into a slowing economy. On the next page, what we show is on the table on the left, the same information on the chart on the right. The lines are just showing you the end of the year where the interest rate curve had been out to 10 years. And what you see is all along, interest rates have been coming up, and it's mostly been in the short end of the long curve. The long end of the yield curve hasn't moved up significantly because what's happened is long-term expectations of GDP growth and inflation have been subdued. Also, we are in an environment where global interest rates still remain very low. While our 10-year is at, over 10%, not 10%, almost 2.5%, 2.8%, you're seeing the German 10-year bond that's about 18 basis points. So there's a big divergence on there. The next thing that we saw in the quarter was that this is showing you the relative difference between the market basket of Treasury securities and the market basket of corporate securities and what the relative yield differences are. And we saw is that as yield differences widened during the quarter, markets became concerned about this, bought more treasuries, allowed corporate yields to rise relatively, but it also created a buying opportunity for the district portfolio during the quarter. So this is just sort of recapping some of those points. But what we see is, from a compliance standpoint, is the compliance of the portfolio that we're managing is in compliance. It's well diversified across a number of sectors, heavily concentrated in the corporates because that's where there was value during the quarter. If we look at this, this is just showing you, the prior slide was showing you the absolute change in each of those sectors. This is sort of showing you what we actually did. Yellows are things that matured or were sold, the blues are things that we bought. And you can see that most of our purchases were in the corporate securities, negotiable CDs, corporate notes, commercial paper. We still did buy some U.S. Treasuries, even though we didn't buy as many as we matured and were sold. So what we see is this is a snapshot of the portfolio. The pie chart on the left is the credit quality overall, very high, AA, and on average basis, everything in compliance with the district's, your policy and the government code. The upper right hand, again, just the diversification as a pie chart, remains very well diversified. The chart on the bottom is just maturity distribution. As you can see, everything was the strategy is to keep everything under 2 years. A real question for the agency going forward is where does it want to be long-term? Because we're in a changed market environment. Again, the strategy over the past several years is with interest rates rising, want to keep it short, you want to be able to adjust into that. We don't know if that's going to be the situation. So that would be a key thing for the agency to determine is where does it want to go long-term with this money. This is just showing the sector distribution over different quarters. Again, not fundamentally different, but it just shows how it changes slightly from quarter to quarter. As far as this is the total return, so this includes the unrealized gains and losses. And so on an unrealized basis, on a total return basis, the return on the portfolio for the quarter was 0.72. So that's about 1.28% on an annualized basis. Versus if I was a longer benchmark, because of the falling interest rates drove up market value appreciation, we saw returns on an annualized basis for longer term benchmarks around 4%. But again, relative to what we've been trying to achieve, it's performed very well over the past several years.
What's considered long-term?
Excuse me?
What's considered long-term?
1 to 3, 1 to 5.
What?
For benchmarks, the longer term benchmarks would be like a 1 to 3 or 1 to 5 benchmark.
And we're at 1 to 2?
You're in a 1 to 2 range.
Yeah.
So the average.
What makes that big of a difference?
It does. Your duration is about 0.79. But the benchmark of 1 to 3 is about 1.86 years. A benchmark of 1 to 5 is about 2.6. So when interest rates fall by 1%, it would increase by that in a sense measure of duration. So you would get about 0.79% of appreciation if it fell 1%. The 1 to 3 would get 1.86% in appreciation if it fell 1%, and then the 1 to 5 would appreciate by 2.6%. So you can see it's a significant difference in those. But again, when interest rates were rising, that's how much their portfolios were declining in value. So again, the strategy worked well to what the agency was trying to achieve, but we appear to be in a different environment. Again, it all depends on how things develop, but right now, it looks like interest rates will be stable to falling depending on how things develop during the year.
Okay, wait, slow down.
Yeah.
Okay, there's a couple things happening, and I was going to ask this question, but this I think is a good time to ask it. Chairman Jerome Powell stated at the beginning of the year that he's going to drop the short-term rate in 2020. It actually said that. It's in print and everything else, which is kind of unusual to say something a year in advance that is going to lower the rate. The question I have is that if that's the case, I want to be able to lock in, if we can, what we have.
Yeah.
You know, short of that happening in 2020, so we'll get the extra 0.5%, 1%, whatever it's going to be. It's all the indications now look like, and I think part of the thing as well is the most important thing in this country is the housing market, and it's dropped 30%. The actual sales have dropped to an all-time low in the last 3 years. The number of sales. Now, our interest rates have dropped in the last week and a half. It's a little funny how quiet it is, but I know people are getting 4% fixed refi rates as of last week. And I just heard somebody today tell me they got 3 7/8 on a purchase. Nobody even talks about that. And just 6 months ago, we were at anywhere between 5 and 5.5%. So the financial market is completely unstable. I don't know how you talk, I mean, how are you going to tie certain things to for our benefit, but the one I'm really concerned about is for the agency is when the chairman of the board actually stated that he's going to lower the rates in 2020, and I can't figure that out. Never heard that before.
Yeah, the difficulty about that is there's nothing to suggest that they would need to do that now, but it really depends on how certain things develop. If the economy is slow, so this is telling some of their forecasts as far as where GDP is, but again, it's not radically that we're going to go into recession. So that will necessitate lower rates. But it depends on how things develop. Do we get a trade deal with China? Does the political situation in Washington resolve itself? Do these things happen in a positive way? We could actually see interest rates possibly go up a little bit. But I think there's a lot of negative sentiment right now, and I think it ties into your comment about the housing market. Even though interest rates have come down, I think people are so kind of shocked in a sense by what happened with the stock market at the end of the year, what's happening in Washington, a partial shutdown. People, I think, are becoming more hesitant. And the difficulty is if people become a lot more hesitant in combined, you can drive a recession just because of that. I mean, if you all don't buy a house, if you don't buy a new washing machine, a new car, those types of things, it will slow down the economy, and you could be in a position where you'd have to cut interest rates. I think Jay Powell would ideally love to raise interest rates, but the stock market basically beat him over the head with the correction saying, no, don't do that. Because, the whole thing is the Federal Reserve would like more ammunition in its belt right now if we do have a recession, but they've been told clearly, and they've heard the message from the markets, don't do that. We can't tolerate any higher interest rates, given that there's no inflation and the economy is slowing right now. So
people are just frozen. I've seen our industry, they're just frozen. They're just like sitting there. It was a fact that it wasn't the interest rate that's slowed down housing market. People just didn't want to, are not doing anything.
Exactly, and there's been, as you well know, significant price appreciation on a national scale in the housing market, which is driven off some buyers, and interest rates being up somewhat, affordability did get hurt. But I think in the current market, a lot of things that's hampering people is just they don't know what's going to happen, and they're hesitant to put a lot of money down on a house. When you don't know, are we going into recession, not going into recession? What's going to happen in Washington? So in that type of situation, we've seen just from an interest rate level, there's nothing there to drive interest rates higher. That the longer term likelihood is that unless things pick up, interest rates will go down. And that ties into the comment suggestion, this may be the time to lock in interest rates. The difficulty is when you have a very flat yield curve and slightly inverted in parts, you could be buying longer term securities at a lower yield than you're getting on very short term investments. But you're doing it on the anticipation, if I buy something for 3 or 4 years, I locked in that yield, and that short-term rate might be gone in, a year and a half. But it becomes, where do you ultimately want to go with that money? If it's stuff that you're going to need to spend, next 6 months, buying 3 years doesn't make sense. But if it's money that we're not going to need to draw down on it, and we want to lock in some protection against interest rates, then it makes more sense to extend it.
So the good news is that we don't have any of our money in anything to do with the California bullet train, do we?
Well, that was our next investment, but we're not do that now. Exactly, no.
Saved us from that.
Yeah.
Okay, please continue.
And this is sort of looking forward. On this table, it's sort of talking about the Fed's projections, and it's, GDP, inflation, what it thinks the Fed funds rate should be, and it shows how the difference went from in its September forecast to the December forecast. And then they're all sort of going down slightly. The table on the chart on the right, what it's indicating is what the market thought the Fed funds target rate would be at the end of December of 2019, how it progressed through 2018. So what we saw is as you got towards the end of the year, October, November, the market was thinking the Fed funds rate would be up around 3%, that we'd see multiple hikes. But since the stock market correction, Jay Powell's discussions, all of those things, you've seen the forecast of what it would be come down to suggest there would potentially even be one rate cut by the end of the year. Again, these tend to be wrong because it's forecasting something that a lot of things will be happening. But it indicates that the market sentiment's really moved away from higher rates to going to more in a stable to maybe a declining interest rate environment depending on what happens over the year. The other thing that we would say is this is just some various indicators, confidence score leading indicators, industrial production, initial jobless claims, and the shaded areas are where we've had recession relative to where these indices have been in the past. And what we're just trying to say is while things may be slowing down, there's nothing to suggest from these factors alone that we're facing a recession in this year or maybe even 2020. But again, it depends on how we as consumers react. Again, if we stop buying the house, the car, the refrigerator, you will have a recession. And this is just sort of relates to one of the earlier slides. The blue line is the median forecast of the Fed's in its December meeting of what they were thinking interest rates would be. And at that time, they were saying, we think we need 2 more rate hikes during 2019. But even at that time, the red line is the market's Fed funds futures. You can see it was suggesting we would maybe not raise rates at all, and then it looks for longer term to see the rates come down. That's the market view of that. So again, that's the environment. We're in a very uncertain environment. Interest rates are probably subject to some extraordinary event that stop moving higher for this cycle. And that what it really ties into is, while the strategy was stay short when interest rates are going rising, if interest rates are going to stay flat, maybe a little down, a little up, where do you want to be? Where do you want to lock your money into? And that's just a summary of some of the things we're looking at in the future, but it's in the package. And that concludes my presentation, unless there are any questions.
The balance of the report is what we are invested in now.
Excuse me?
The balance of the report is what we're invested in now.
Exactly. It's just the detailed issuers, so how the specific issuers that we remain very well diversified. And this was the activity during the quarter to just give you the details about it. And then the portfolio holdings are the specific securities you owned as of 12/31/18. So it's more of background information.
That goes on. Is that going to be a bond or stock that people are going to purchase? What's going to happen there?
As far as unwinding the conservatorship, the whole thing is what we would expect. Is like I think when they did Sally Mae, that the government would in a sense state that will stand behind the existing bonds that have been issued. Then the question becomes, is anything they issue after that is this a private corporation? And then we would evaluate it as such if we were going to look at it. So it would depend on how it's structured, how it's capitalized, everything else. But there's, based on history of similar events, there's very little risk to the existing agency bonds that you own. So, but whether they'd be good investments going forward, that we do not know. But it could substantially change the dynamics of the market because, public agencies have to invest in very safe investments, and suddenly one of their major investment types would go away. The difficulty is, I don't know how I would judge whether it actually happens at this point. It's been talked about, it's been something that they're supposed to have done, but they're making money off of it right now, so I don't know what motivation there is behind that, especially when some other things that you would think could be easily resolved adequately.
Making money because they need to get a loan.
Yeah?
I've got a question on the chart on page 13.
This chart?
Right.
Yeah.
You've got titles of the columns such as indicator 2018 and 2019, and then longer runs. Can you
So
explain that?
these are from the Federal Reserve, the FOMC committee. So what they sort of do is say, this is what our forecast is for 2018, this is what we think it will be for 2019, and then we think what it would be longer term, but the longer term isn't 2020. It's sort of beyond that. So they haven't really defined it as being the next year after that, but the next several years after that.
Well, it's interesting that they would categorize, they would have two categories, September and December.
And what we were trying to show, and I probably didn't do a good job of explaining that, is September is the forecast they did in September. December is the forecast they did in December for that period. So for example, what you can see is that for 2019, GDP that they were forecasting was 2.5% in September. Then they downgraded their forecast for 2019 to 2.3% in their December forecast. So what we were showing is that some of their forecasts between September and December softened. But again, I would suggest, longer term growth is still anticipated to be about 2%. So they're not suggesting we're going to face an imminent recession, as is determining how we develop as an economy. Did that answer it?
Yes, good, thank you.
Good question. Any other questions?
Yeah, do you personally see interest rates going down this year, or what's your?
I wish I could forecast that in the sense that, over the past couple of years, I think I could say with good confidence, absent a significant event, that interest rates would be higher. I don't have confidence. My bias would be to interest rates to be slightly lower at the end of this year than they were at the beginning of this year. But it really depends on how these events develop. Trade war, political situation, if economic growth globally picks up or slows down. So it really depends on how those develop. There's not the big impetus there was in 2018 where we had the tax cuts and everything else. And the other thing is longer term, we're facing a lot of other significant developments in the sense that the federal budget with interest rates where there are, is going to be running significant deficits. It'll be interesting to see what happens in California as far as its budget, because with the stock market down at the end of the year, with the revenues dependent heavily on the highest wage earners who depend a lot on what's happening in the stock market, we could see the revenues coming down this year, which could have off-coming effects on all the local agencies and that. In New York, Como was talking about how they've seen a drop in the revenues. Also the SALT deduction going away this year. So there are a lot of things up in the air right now.
Well, we just got a forecast, company that anywhere between 2 and 3 million, $100,000 a year retired wage earners will be moving out of the state here in the next 3 to 5 years, out of the state with those revenues. I always said to myself, $100,000, they're paying taxes. They're not going to be paying taxes anymore. And there's more people moving in, but they're not moving in with $100,000 salaries to replace the ones that are leaving.
Yeah.
And what's interesting is several people I'm encountered with, they're buying their primary residence in other states, and they're commuting, for their work and stuff like that. And one of the big things we're seeing in the aerospace industry, these engineers are not selling their houses out of state to move into California, Palm Hill, Lancaster. They are getting housing, monthly housing accounts of $2,500 to $3,000 a month housing expense. So they're not buying, they're renting. And we're seeing a completely change in attitudes and personalities when it comes to people with good career jobs. buying properties now, they'd rather rent. And what they do is the lead person rents the house for $2,500 a month, and then the other two rent the rooms, sub-rent the rooms for them, and they split it basically for $700 a month. And so, it's pretty interesting.
Yeah, I think the state in general faces a lot of challenges over the next several years, which may not affect necessarily short-term interest rates that you can invest in, but will be definite developments that will impact your agency. You know, for example, CalPERS and all of that, that the fact that a lot of the local agencies we work with, their contributions to CalPERS and other retirement programs are going up and needing a lot more of their budget.
Well, the two biggest projects in the state of California right now, one of them was scrapped today. The governor said they're not building the train from LA to whatever. They already spent $10 billion of wasted money. Same old story. And the second thing he said today, Gavin, is that he's seriously going to scrap the second of the twin tunnel. Did you hear that? So, I mean, all this money we've been spending from this agency and all these agencies, these people are killing us in the state of the wasted money that's going on right now in the state of California. We're talking billions, you know, that could be used for roads and other things. But so it's going to be interesting. I just want to make sure that, as a director, that our funds are put in to anything to do with California when it comes to projects or things like that leverage. This board definitely needs to be aware, because make sure we're not putting our money into these bankrupt projects that the legislators are putting us, the state of California in. So we got to make sure of that.
Exactly.
You know, you weren't around, but I saved this agency over $10 million when I told them to pull it out of Fannie Freddie Mac before it crashed, because of the industry I was in. I knew they were going to crash. I knew about the subprime loans, and we pulled it out, and we saved the money for the agency just before it crashed. Everybody lost their shirt that bought those bonds in Fannie and Freddie Mac. So I'm just very cautious about things like this.
Yeah. And a lot of uncertainty right now, and you know, where it actually develops depends on so many things and how they actually fall out.
Do you get the impression that trade relations between China and the U.S. are going to improve?
Long term, yes, I think they're going to improve. The short term is each side has a lot invested in it, in the sense that intellectual property, the trade balance, all of those things have been very strongly negative to the U.S. for a number of years. But at the same time, you know, China has a economy that it needs to keep growing, and right now it's more of an export-driven economy. So they want to do as little as possible to subdue that. So they're going to give up as little as they can, and you know. But I think ultimately it's in both countries' best interest to have improved trade relationships. You know, but then you also throw in Brexit. That hasn't been resolved. It's supposed to March is when it's supposed to happen, and we don't know what the deal will be, and that could create additional, you know, ripples in the global economy. So there's a lot out there right now. So, and if I could predict it, I'd be the billionaire, and unfortunately, you can see I'm not a billionaire.
You know, I got a question for you, because this has not been seen. I don't know, maybe in my lifetime, but the housing write-offs on property taxes is low to 10. This is like the first year that people be sending their tax returns nationwide. The maximum was $10,000. I mean, there's many, many celebrities and very well-to-do people that are paying $20,000, $30,000, $40,000, $50,000, $100,000 a year in property taxes, which is now limited to $10,000. That difference in their write-offs is going to change, which means there's going to be more money coming to the feds, because they're not going to be able to write it off against other things. The other thing too is entertainment. Business can no longer write off sports tickets. They're not going to buy the skyboxes at the Staples Center unless they just want to spend the cash.
Yeah.
So those write-offs is money going to be coming back into the system. So I think you're going to see a different economic change in the next couple of years.
Yeah, the difficulty, and I agree with those points, part of it though is the amount of debt the federal government's, you know, accrued over the past several years is there's going to be a significant interest rate load on paying that, as interest rates have come up relative to where they are. I mean, the 2-year at 250 right now, you know, from you and I, it sounds low from our history, but at the same time, when the 10-year average of the 2-year treasury was 85 basis points, you can see the impact it would have on how much interest rate the federal government's going to have to pay. And that's going to start wiping out any additional income they would get from some of those things. Would be the forecast I've seen from like the CEO and those types of things. So it's going to be an interesting time. And then in 2020, we'll have an election. So that'll create additional uncertainty, and the parties neither want to work together, especially it might give the advantage to one or the other.
As long as we make 2%, I don't have a problem.
2%, okay, that sounds good.
And it's sad that, in a sense, you know, when I started my career, if I said, hey, we're going to give you 2%, they'd hit me over the head with a baseball bat, you know. Just,
Hey, some of us board members paid when it was 5%.
yeah, you know, it's insane that it's this low, and it's anticipated to stay in this sort of low range for a while. But then again, longer term, there are a lot of inflationary impacts out there.
The good thing about the discount rate is that it's helped this agency immensely, because we were able to refinance bonds and get virtually less than a quarter percent
Yeah.
adjustable rates. That's helped pay us our bonds down to be able to borrow money. So it's really helped. I mean, I personally like to see I would exchange the return on our investment to be able to capitalize on borrowing other money at a lower rate.
And that's the dynamic in an economy, that the lower interest rates did a lot to stimulate coming out of the Great Recession. But at the same time, if you were a retiree relying on that investment, you know, you were hit hard. Certain people, you know, there's winners and losers in every scenario. So, anything else?
Yeah, very interesting.
Thank you.
Thank you.
Okay. Okay, so let's see, we got revenue. Okay, we get a board order, 6B1. I make a motion we approve the presentation by PFM Consultants.
I'll second.
Any questions? All in favor say aye.
Aye.
Opposed? Motion passes.
Okay, that brings us to the next item in the agenda. This is our revenue and expenses report for the second quarter of fiscal 2018-19. Dwayne, start on it.
Yes. Yeah, continuing your board packet, this is for the second quarter, so the way to look at this is we're at 50% of the year with regards to our revenues and expenses. And going over the kind of give you the bottom line here is the total revenues are at 59% at 50% of the year, so we're about 9% over to the positive with regards to revenues. And for expenses, we're at 46%, so we're 4% under what we projected in the budget with regards to our expenses at this time. If you look at in the staff report, we look at operating revenues at 52% and operating expenses at 46%. The non-operating revenues are the area of greatest gain, and that's at 68% versus the budgeted amount. And then our non-operating expenses are at 46%. So from this very quick look at our financials for the fiscal year, you can see that the agency's in very good shape financially moving on to the second half of the year. I'm happy to answer any questions that you may have.
Okay, I'll move on. Board order 6B2, so we approve the revenue and expense report for the second quarter.
A second. Any questions? All in favor?
Aye.
Opposed? Motion passes.
Okay, this is 6B3, accept and file the check registry. This from January 17th, 2019 through February 6th, 2019. And any items you want to bring to?
No, there's finance committee review day.
Okay, we did review it first. And so I'm going to go ahead and move on to order 6B3.
Second.
Any questions? All in favor, say aye.
Aye.
Opposed? Motion passes.
6B4, accept and file the treasury report for month ending January 31st. You know, Teresa's here. Teresa, just give us a little one. I didn't want to waste your evening tonight, so I think we put you. She always puts out a good report about our earnings, and in fact, we're doing pretty good, so.
Okay, so the treasurer's report that you have in your packet is for the month ending January 31st, 2019. Average yield to maturity for the total portfolio was 2.3%, which is up 0.097% from December. Average days to maturity for the total portfolio was 291 days, or just under 10 months. And the total cash and investment balance at January 31st was $101,174,497, which is down $3.1 million from December 31st. And as discussed in the staff report, there's our January and July DWR payments are a little higher, so that accounts for that decrease in the cash balance. And I'd be happy to answer any questions.
Any questions, Alan? Okay, now go ahead and move on board order 6B4, accept the file treasury report.
I'll second.
Any questions? All in favor say aye.
Aye.
Opposed? Motion passes.
6B5, purchase orders over 25,000. There's one here, moss screens. I'll let Wayne go over.
Yes, what we have, actually we have two that run at the headworks of the plant. And the existing ROS screens are about 7 years old. They need to be repaired in order to be able to get through the warm winter that we're hoping to, warm summer, I should say, that we're hoping to have. We have the good fortune to have one of the premier moss screen manufacturers and suppliers right here in Kern County, in Bakersfield. And they've supplied this equipment to the agency, and they're best suited to be able to repair it. The cost for the repair is $76,431.02, and staff would recommend approval to repair those moss screens. Happy to answer any questions that you may have.
So repair is better than replacement.
Yes, because you don't have to remove the outside structure, so you're just replacing the wear parts and the bearings and various parts like that. So carrying the whole structure would be much higher.
Okay, I move on board order 6B5 to accept the purchase order for the moss screens.
I'll second the motion.
All in favor say aye.
Aye.
Opposed? Motion passes. Moving on to item number,
I conclude my report.
oh, so sorry. Sorry about that.
It's a
Item 6C, Planning Committee, Director Dias, your report?
Yes, thank you. Item 6C1, meeting of January 29th. At this time, we have no request for any board action as a result of that meeting, but item 6C2, sponsorship of the 2019 Home Show and Smart Water Expo, we do have a board order, and I'm going to ask our general manager to make a report on that.
Thank you very much. Well, as you might remember, last year, the Smart Water Expo was combined with the home show that the fair puts on last year. It was a very successful program. The Antelope Valley State Water Contractors Association has approved a $10,000 sponsorship for that program. If you remember, when we were doing it ourselves, it was well over $25,000, so this is a reduction in cost for what we had spent previously. The agency's portion of this $10,000 expense would be $8,570, and it's contained within our approved budget. So it's a budgeted item for us to expend, and staff would recommend that we go ahead and approve a board order that would authorize that expenditure for the Smart Home Expo to be conducted with the home show this year. I believe, not sure exactly when that date is, but.
Yeah, it's March 22nd through March 24th.
Thank you, Matt.
I'll move on board order 662. Second.
Any discussion?
I have a question, please. Okay, I'm a little confused. You said 10,000, I'm looking at, it says sponsorship here, says, this is contributed $8,570.
Correct. It's through the AV State Water Contractors Association. The other, Little Rock and Palmdale will contribute the balance of the money to get to the 10,000. Our share is just $8,500.
So it's a joint effort.
Yeah, I know it's a joint effort, but I think that's ridiculous. I mean, they're coming up with $1,500 between the two other agencies. I mean, that's ridiculous. I mean, marketing, if we don't want to do it, I mean, we're doing it as, I don't know why we're doing it, to be honest with you. But I know what we used to do and what we've done, but if we're going to participate with groups, this fee, in my opinion, is not fair. That's all I'm saying. I'm not saying that we shouldn't do it with them. I'm just saying this dollar amount is ridiculous. I mean, Palmdale's a big agency. They make a lot of money, okay? Little Rock makes a lot less, we know. And then only pay $750 and we pick up $8,000? It's just not right. That's just my opinion as one director.
What's it based off of?
It's based off table 8 allocation, so that is per the bylaws.
And you know what, we need to look at that and maybe start looking at that and re-evaluating the percentages. That's what I'm saying. Because we're not Big Brother. As much as I respect and like Palmdale Water District, we're supposed to do this as a partnership, not be the Big Brother. And I think it needs to be, reevaluated on the percentages, what we do. Because you know what's interesting? We're buying their water, we're paying full boat on the water that we're doing over with processing to send over Acton. We're not asking for any participation on that. So it's always, we're carrying the main load of everything in the valley. And I think we need to be more, I think the percentages need to be looked at. That's my feeling on that. Okay, and I have no problem sponsoring or promoting a program with them. Are we going to do the same thing with Big Rock Creek? We're going to come up with 90% of the water, and they're all going to come up with 1,000 acre feet. We're going to come up with 8,500 acre feet. Is that what's going to happen here?
It's Big Rock Creek follows the same percentage, but the benefit.
We need to reevaluate. I'm telling you, we need to reevaluate.
Let me finish. Okay. We're also getting 85% of the water that's being recharged into the ground. So there's a direct benefit to the payment that's associated with it.
Well, we still need to look at that. Maybe we don't need 85%. Maybe it's better for them to have 25%. I'm not saying that. Or same thing with Amargosa Creek. All I'm saying is they're a big boy, and I think that we need to respect their size of their agency. Maybe we should participate, let them allow them to have the opportunity to participate for more water, because maybe they need more water. You know, I have not anybody say that to me as a director, that maybe just because we've been doing it, we got this thing started. I was, you know, first involved with it. I think it was the greatest thing to do. I'm very happy all of it, but we need to reevaluate the percentages when it comes down to certain things. This is my opinion. And I will support this.
Okay, do we have a motion?
Oh, okay.
I'll make a motion.
I'm on board over 6.
We already have a motion.
Sorry.
Yeah.
Let me have one already.
Marvin made a motion, yes, thank you very much, yes, we're in discussion. Thank you. So, all in favor, say aye.
Aye.
Opposed? Motion passes. Thank you. Director Dias for your report. Does that conclude your report?
It does.
Okay, fantastic. Item number 7, General Manager's Report. Mr. Chisholm.
Well, we had some news today. As Director Denal mentioned, Gavin Newsom's State of the State message came out and indicated that his office would not support a twin tunnel program. He's gonna, but he did recognize the fact that conveyance was a high priority for the state. He prefers a one tunnel option to that. One tunnel. And so DWR will be, reanalyzing that. It also indicates, at least from my point of view, that there'll probably be a couple-year delay, in the project moving forward as they reapply for the various things that they'll need to reapply for through the one tunnel option. The environmental document had already previously analyzed a one tunnel option, so there's, that's been in the works for a while. So DWR will go through that and is working on it now. I'm confident. And so more to come, but definitely the two tunnel option is not supported. And but he did reaffirm his commitment to having a one tunnel option and increased conveyance, because that conveyance is very critical to be able to stabilize the water coming to the south. It was also interesting that he pointed out that that we need to get over the north-south thing, where people are against it just because they're north, and people on the south should, understand each other, and we need to get over that. And also the farmer environmentalists, we need to stop that, because we need to just build one tunnel, get it across there, and get it done in an economical and appropriate way.
I was hearing something on a radio show that there's also talk that he is not encouraged the way the CEQA document's being done in California, where it's really delaying and causing issues. Have you heard anything about that?
Yeah, he mentioned in his State of the State, in particular when it had to do with housing. He was very frustrated over the housing predicament and the fact that environmental documents really slow down the process. In his speech, he mentioned that. So
We talked a lot about that at the CFI conference, and the governor's director of housing was there and spoke to that directly.
Right. The other thing that he spoke about and was very firm about was the water tax, as we've talked about before. He's very adamant about having some long-term funding source available to make sure that all water systems within the state of California meet potable water quality requirements. So we'll probably see a big push to move forward with something in that direction on a long-term revenue supply, I'm going to use the word supply, I should say, long-term revenue sources that will be able
That's a
to.
good word.
Yeah, revenue.
So
Yeah, that's the problem.
he thinks that the state can take care of the underserved areas
Yes.
better than the locals can.
Yes. He wants to make sure that there's sufficient revenue to be able to do that. So, and he thinks that's, I got the feeling that that was something he's going to push very strongly for.
That's why he put it in the budget.
What about the gas tax? I'm not talking about car gas, I'm talking about the cow gas tax.
That's what I'm talking about, yeah.
Okay.
The water tax had revenue sources coming from fertilizer purchases and dairies in particular.
Bill Gates just came out tonight, about 2 hours ago. He's opposing it, and he said he's gonna have a national, I'm not joking, I just got an AP thing that he's really fed up with this stuff that's being proposed nationwide.
Right.
It says it's preventing jobs, it's preventing people opening businesses, and it's just one thing after another. I thought that was pretty interesting.
Correct. Yeah, I'm sure there'll be a lot of back and forth. That's what the two pertinent water issues that are associated with his speech came out and said today. So I'll pass that on.
Thank you.
Okay. Okay. Some interesting, we've had some interesting weather, the 10-day forecast for our Feather River region that supplies the water to the State Water Project. It's snowing today, and they're expected to drop about 2,500 feet. They're going to be snowing and raining and snowing and raining, so there's a lot of water in the system. You can see here what these storms have done, and this is as of January 1, so you can imagine since January 1 the picture is even better than it is now. You can see those red portions primarily in the Ventura, Santa Barbara area where they were still under an extreme drought. They're no longer in that state, and I imagine by the end of February we'll probably be out of a drought altogether along the state. That's what I do. There I did. Push the wrong button. Here's the chart we've been following, having to do with the precipitation. We can see that we're at 19.4 inches. We got this little bar here for, let's see, what do you do here? What the heck? I don't know how that happened. Must have went back to his. It's on a rolling thing here, so let me get back to where it belongs. Oh, you can see the February bar is the one that's all the way to the right. We're only 12 days into it. You can see how close we are to average. So we're going to far exceed the average for February with all the rain that's anticipated over the next couple of weeks. Looking at our state weather items, you can see we're at average, we're at above average with regards to the northern area. And you can see the map in the kind of the left-hand corner. And then what's most important to us is the San Joaquin area. And the San Joaquin River provides when it's wet and there's a lot of snow and a lot of releases, it provides a lot of ability to move water without causing any difficulty with the cross canal and the negative, what they call negative old OMR, which is Old Middle River. So it's just an acronym. So they changed the flow there. When the pumps come on, and there's so much water coming in from the San Joaquin on the south, it doesn't have any effect on that, so we can increase the pumping. So I always look at the San Joaquin River to get an idea of how much water we're going to be able to get and how much data land there's going to be. So you can see that the reservoir levels are pretty good. We're getting very, very close to our capacity in San Luis Reservoir. More about that in a minute. We're still below on Lake Oroville, but with all the snow and the other, they'll be creeping up to their level pretty soon. So everything's looking good from a water capacity point of view in the state. Here's a couple of diagrams having to do with Lake Oroville. You can see that we still have a ways to go there. And this is San Luis Reservoir. And where we are now is we're anticipating that we're going to be hitting a spill of San Luis Reservoir in probably about a week's time. What that means is that some of the water that is carryover storage will potentially be lost. Staff is currently looking at what our exposure might be to that. However, I think our exposure will be very, very limited to 40,000 acre feet in carryover. We're down to 23,000 acre feet, so we may have a few thousand acre feet of loss, but nothing like we were from the previous time 2 years ago. So we kept our carryover right about that 20, 22, 23 range, so that we have very limited exposure to spills. Now, what we do is if we spill some and we lose some from 2018, we get extra Article 21 in 2019 that kind of makes up for it. And so we're going to earlier this week, I guess that was yesterday, directed the staff to start up the West Side Water Bank and get it working full bore as quickly as possible, and they're working on that to be able to do that, to take advantage of as much water as possible as we can get. So we should be up at full range right about, hopefully we'll be there by sometime next week. And we're hoping to also be able to use this water for the Big Rock project. Get some more water moved before it gets spilled. I wanted to add this, it's a very busy slide here, but this slide tells you on the top it's a date, and that date is the month basically, and then there's these 5 actions, and these actions correspond to the biological opinions. So each time you look at February, there's 1, 2, 3, 4 actions that may govern how the State Water Project is operating. So one of those will become what they call the controlling action that's required, and it's associated with the fish operations. So just as you get out of one, you get into another. So there's nothing here to do other than to realize that, in January and December and January and February is very difficult because there's so many actions that are necessary, even when there's a tremendous amount of water available. So we look at snowpack. Snow is at 129% of average for the whole area. You can see this is on the bottom is the southern area, and as you go up further up north, you can see we're right average or above. So when there's more snow projected. Locally, here's our totals here. We have, we're running about 9.4 million gallons a day, about 3.6 in geopurification, only 13 million gallons a day. One of the byproducts of having a rain event, as much as we have, there hasn't been a lot of demand for our water supply. If you look at our current flows, we've got about 6 million gallons, which is a trickle coming out of Port Hartsville, 3.1 million gallons out of Roseman, and the exchange has 0.3 million gallons a day. Our water banking and deliveries, you can see we got about 2 million gallons a day going into the west side water bank, and that will be ramped up more and more as we move forward. We've got 1.6 to the east side. Oops, made a mistake. Got fingers. This is a new graph for you that we prepared for 2018. Or 2019, I should say, and what it shows is the light blue numbers is the request that our customers have made for water supply, so you can see exactly how much they have requested. And then we've shown on the dark blue graph, and we'll track this over the course of the year, how much water was actually delivered to our customers.
Based on their demand?
Based on their demand,
Okay.
yes. This is what they projected, and this is what they actually took.
Right.
So we can see what the difference is as we go
So
through.
in January, we could have given the 2,500 acre feet, but they only asked to actually use 2,000.
They asked for 2,500 acre feet, but they actually only took
Okay,
about 2,000 acre feet.
okay, but we were prepared to give them what they wanted.
But that's correct.
Thank you.
Yeah, absolutely.
Go ahead.
Are we working on some method to, if they're requesting more than what they're actually taking, to tax it in some way to return to us the expense for us to make it available?
The other way is to try and take that excess water and remarket it to other outside agencies as a way of moving forward. So we just need to look at it from that point of view, and there's I know the Water Rates Committee is very concerned about that, so we thought we would track what the actual numbers are so we can get an idea of the amounts that we're talking about.
Thank you.
What about take or pay? Is that, I kind of thought that's what you were referring to, Director Harris, were you?
Yeah, exactly. Or some type of, I mean, it costs us money to make so much water available. We're giving up other opportunities to market the water when our customers are asking us to hold it for them. So we should have, I would suspect we should have a meeting with them, talk about it, and come up with what would work for everybody to make up for that.
We can certainly do that.
And I guess the Rates Committee is probably looking closely at something like that.
And one other thing that we prepared that we went over with the Finance Committee yesterday is this graph that I put up on the board here. I know you can't really read it very well, but we did provide a copy, I believe, at your desk so you can take a look at it. What it provides is a prediction of our total demand versus our supplies, and we looked at all of our supplies. And then we looked at the amount of table A. So, you know, if we start with 15% table A, and then if we go up to 20, 25, 30%, exactly where we would be on how much water we would need. So if you look at it, we're right about 25% or so. We end up meeting all of our customer demands, and we're able to, once we get over that 25%, then that water's available for remarketing and other types of things. Latest guess today from some fairly knowledgeable people is that we're looking at about 50% here based on the hydrology that we've seen so far. So we're planning on trying to take that difference and look at doing some remark.
It'll be 75, watch.
Could be.
I just got the
We need a
report
scoreboard.
right now.
Yeah.
Truckey's expected 12 to 15 inches of snow tonight, and Mammoth is expecting between 3 and 5 feet of snow.
Right. Undoubtedly, there'll be enough water to go there. It's just a question of whether we can get it across the delta, given all those biological opinion actions that have to be.
Well, maybe they'll wash out the delta smell. We don't have to worry about it.
There's enough water.
Right in the ocean.
Yeah.
Wayne, have we had any more discussions with the LADWP regarding excess water coming through the aqueduct next to our water bank?
We haven't had any recent discussions with LADWP.
Could we renew those discussions?
We sure can.
Because in 2017, they would have had an opportunity to bank a lot of, or some water with us, maybe a significant amount of water, and it runs right next to our water bank, and we should renew those discussions.
We can certainly make it work.
Great, thank you.
Okay. From a water quality point of view, we're still looking very good in that. We had a quarterly, our next quarterly compliance sampling is at on 2/21. And Jordan Ray, our newly promoted laboratory director, got ELAP approved for that position. So.
What's ELAP?
You would, and that's a good one.
It's I believe it's Environmental Laboratory Accreditation Program.
There you go. See?
So she took that?
In other words, she contacted the organization. They looked at her from her background experience, all of those things, because they get to determine as whether you're qualified to take on the laboratory manager position, because they're protecting public health and those kinds of things. So they go through qualifications. So, and she passed with flying colors. So. As we mentioned here, I've already talked a little bit about this, as far as what the Twin Tunnels project has to do. One of the things also is, and I can't pronounce this gentleman's name other than Joaquin Escobar, or anyway, he's the new chair of the State Water Resources Control Board. Felicius Marcus. His term has expired, and Laurel Firestone is going to go to the State Water Resources Control Board to backfill that position, as Joaquin is actually on the board now, become the new board president, and William Lyons become the agricultural liaison in the office of the governor. Just to give you an idea of some of the folks, and that was for Gary, because I know he's agricultural issues are important to him.
Didn't he just have this discussion today?
Yes.
Like 2 hours ago?
Yeah, it was about 11.
3 hours? Oh,
yeah.
it was 11.
Yeah,
Good job.
11, 12 o'clock.
Good job
Yeah.
getting us relevant information.
Yeah.
So current.
So before we leave this, we did, in addition, while we were listening to the state of the state, we also had a call from DWR that Article 21 water will likely be available in about a week, so we're preparing for that too. So, as far as the status and updates, the AVEK Board of Trade Business Outlook Conference is on February 22nd, Water Master meeting on February 27th. River Water Institute, 27th through March 3rd, CP Roundtable, March 7th and 8th. I will be in Sacramento next week to hear about the fallout from the governor's statement and work with the state water contractors. Overall, I think it's I think the governor's approach to the California water fix is a positive one. I think it reduces the size of the project, makes it more appropriately sized for the amount of demand and participation that the project's going to have, and I think it'll probably move forward rather quickly. So that's all I have. If there's any other questions for the board.
Excuse me, Madam President, I mentioned something. Just to clarify a statement earlier about the Big Rock Creek project. As mentioned, Dwayne mentioned that the project cost associated with that is split based on Table A. I actually looked up, we have an MOU for that particular project, and it's split 47% AVEK, 47.5% AVEK, 47.5% Palmdale, and 5% Little Rock. So I just wanted to clarify that just so we didn't leave here thinking.
Well, I didn't have a problem with that.
Yeah.
That's how everything else should be done too.
Yeah.
You
So-
can't pick and
No,
choose.
no, you don't make one project special and the next one something different and something else different. Okay? No, you don't do those things that way. It should be, that's how it should be, 47, 47, and whatever you had, I think that's more than fair.
So I just want to clarify, because we mentioned.
Yeah, thanks for bringing that up, that's really
Thanks for
good.
bringing it up and letting us know, appreciate it.
Dwayne, I had one question. Do we owe anybody any water? I know Tahoe, maybe it's a good year to pay them back.
Tahoe's already been paid back. We don't owe Tahoe any more water. We paid
We don't-
back.
Nobody
last year.
else?
We have a couple of small folks that we owe water to, Little Rock and others, but nothing that they can take right now. So we don't have any major obligations other than the ones we have.
Okay. Real quick on Little Rock Dam, are they taking the sediment out of there right now, or what's going on?
I couldn't tell you, I'm sorry. I got a feeling that they probably aren't, water's coming in, but that's my guess.
Dwayne, would we be able to use Big Rock Creek for Article 21 water this year?
Not likely this year.
What approvals would we need to?
We need to get right now we have a temporary approval. We'd have to make that approval more permanent with DWR because it was a project-specific approval. So, yeah. Once we get through this year, we could, we could file the appropriate notices and things like that with DWR to get that to a more permanent facility. And then the issue with that is once you get past the pilot project, you have to do all the environmental work and the other things that are associated with the project. Because it is a project at that point.
What about Armagosa Creek? When is that going to be online to start taking water?
What's the latest? Do you have
I think we're still looking at about a year from now. Best case would be late 2019.
And then will we be able to use our new water bank for banking Article 21 this year?
Yes, we'll look at what we can do to get us, very much like we did 2 years ago.
2017.
Yeah, we'll look for every place we can find.
East side, west side.
East side, west side, middle side, yeah, big place. High desert.
Okay, item 9, directors' reports. Do any of the directors have anything to report this week? Okay. Number 10, attorney's report.
Nothing to report.
Okay, closed session. Do we have a need to go into closed session
We
tonight?
do.
Yes, we do.
Okay, on which items?
We would be item D and item E.
That's it, just those two?
That's just those two ones.
Great. Do I have a motion to go into closed session?
I move we go into closed session.
I'll say.
Everybody, all approved, say yes?
Aye.